morning, everybody, to our conference. Good morning, ladies and gentlemen. I'd like to welcome you to our Global Academic Conference. My name is Gstädtner. I'm the president of the Supervisory Board of the EBI. And today our conference title is The Banking Union at 10, European Banking and Capital Markets Law between 2014 and 2024. First of all, let me congratulate the academic board, and especially Christos, Gortsos, who I would like to welcome, for putting together such an interesting program and for the discussion. I would also like to welcome all the panelists, all the speakers, the moderators who have accepted the invitation. Especially I would like to welcome Eva Hüpkes, sitting here. Welcome, Secretary General of the International Association of Deposit Insurers, IADI, it's called. And is our keynote speaker for this morning. Let me also especially welcome our speakers from public authorities, Karl Philipp Wojcik from the SRB, Stefan Panoke from FINMA, I've seen, Despina Tachimanoli from the EBA, and then Chiara Ziglioli, Eleni Kopedidou, and Klaus Lackhoff, my colleagues from the ECB. In the audience, I also would like to welcome Anneli Tuominen from the Supervisory Board of the SSM. And for the EBI, let me also welcome Enrico Leone, who's the Chancellor of the EBI, and all the members of the academic board. Welcome. First of all, also a thank you to Goethe University in the IMFS and Professor Wieland, who would like to welcome here as well, for hosting us today and for being the co-organizer for this conference. It is a pleasure to see again so many faces in an auditorium. In the last years, we all got used to have virtual conferences and meetings, which from the perspective of panelists and speakers are not very interactive, as you can imagine. You speak into a screen and usually don't see many faces, and there's hardly any interaction with the audience. Now, at least I see many faces here in the audience. We also have a live stream, so we have many more people also virtually participating in this conference, and I hope there will be many more discussions in the course of our conference. Before we start into the day, allow me a few words. To start with, the EBI is not yet 10 years old, but only 8 years. And we are not as highly developed as the SSM and the SRB. Nevertheless, the EBI is now an established European institution in the field of academic and policy research in banking, banking regulation and banking supervision, and capital market regulation. This is impressively underlined by today's agenda and the high-level panelists and speakers discussing various topics in this field today. Banking Union at 10, European Banking Capital Markets Law. It's a big title for a big conference. We easily say Banking Union at 10. I guess the first question is, do we really have a banking union? This is probably not the case, at least not fully fledged. We have an SSM, we have an SRB, which are obviously key parts of a fully fledged banking union. However, a European deposit insurance scheme is missing. Some are happy about that because they think it's not necessary. Other ones see this as a key part of a fully fledged banking union. Then we have the basis on which these three pillars are supposed to stand, the single rule book. Do we have a single rule book, or do we have 19 different ones? Many of the panels have a particular legal angle in which we can discuss this question. When you ask practitioners, and I see many of you here, practitioners in this field will certainly confirm that there are many, probably too many fields where the single rule book is not that single after all. We surely hear more about this in the next 2 days. The first session is about Basel III implementation, and I'm curious to hear the views of the panelists on this topic. Finally, you can also ask whether we really have European banks. I guess a key ingredient of a European banking union. Also here, I would make a big question mark. So, banking union at 10, not really, but on the way there with a good progress and momentum. At least parts are missing, but we can discuss this in the next 2 days. The other areas of this conference is capital markets. Capital market union is as well a big topic, an idea the EU is pursuing already for some time. It is also a key building block for a more stable monetary union through financial integration. However, The concept of CMU is also difficult to grasp. What exactly belongs to a capital markets union? How far have we come in that regard? And what areas of capital markets law really work? Lastly, we also have panels dealing with digital and sustainable finance. I guess the new age of finance. Our two panels will cover two mega trends in our society from a finance perspective. How is digitalization changing our society, and how can we transform our economies to be sustainable also from an environmental perspective? These topics will be discussed tomorrow, and I very much look forward to that. Let me now finish, and I would like to hand over to Volker Wieland, Professor Wieland, head of the IMFS and member of the academic board of the EBI, and today our host. So Volker, thanks very much again for that, and also for your patience, and I'd like to hand over to Volker.
Well, thank you very much. It's also my pleasure, of course, to welcome you all again in person, finally to Goethe University here in Frankfurt. So I guess I'm one of the people representing Goethe University today, and I think it's a great pleasure to welcome you on this beautiful campus. Actually, we're not often in this room. I think we've never been here, but because actually these 2 days, I guess there's a lot going on at the university. But I think our team picked a good location. So thank you also to the team. Furthermore, maybe just to say a few words to IMFS, the Institute for Monetary and Financial Stability. We're basically tasked by Goethe University at the time when Goethe University joined EBI to support that and help manage that. And so that's why I'm here. I'm not a lawyer, I'm a macroeconomist, and as managing director of that institute, I've been involved, and it's been a pleasure, although most of the time of past years, not as much as I would like to, particularly because of my work for the German Council of Economic Advisors until 2022. So I'm even more happy to be able to listen to you and learn more about also the legal foundations of financial stability and of banking union and of the stability of the euro from you. I would like to point out in particular, I mean, the key person from our institute, oh, I forgot to say, the institute is a research center, a university center, which is a joint initiative of the business and economics faculty and the law faculty. And so I think in that sense, very fitting, and as the name says, tasked to work on monetary and financial stability. But the key person from our institute who's actually been there from the start of founding EBI and pushing forward is Tobias Tröger, who's sitting here in the first row and who will be also on a panel this morning. And so mostly the thanks are due to him, that he basically, from our side, contributed to this fantastic initiative. He's a professor of corporate law, and we have other law colleagues in the institute. You may remember Helmut Siegmann who's on the monetary law side, is retired but still very active, and his successor, Roland Brömel, who's also from the public law side. So that's it mostly from my side, but if the organizers are okay, I mean, if the co-organizers and Christos are okay with that, I will also briefly introduce our keynote speaker. Mrs. Hüpkes, is of course a great pleasure to have you here, and we'll be listening to that, so to what you have to say, which is of course very important. So I'll keep it relatively short, but nevertheless, Gstädtner already said that the Executive Council of the International Association of Deposit Insurers has recently, not that long ago, appointed to you as the General Secretary or Secretary General of the institution. So that's a very important for our purposes of our interests of financial stability, a very important role. But this is one where a topic you've been involved for many years, right? You've worked for a long time, since 2009, at the Financial Stability Board, so right at the center of the oversight and regulation, watching and developing center of all those involved. You've made many contributions. You've been head of regulatory and supervisory policies at the Secretariat of the Financial Stability Board. Before that, you worked at the Swiss Financial Market Supervisory Authority, FINMA, of course, also a very insightful institution and position, and also recently last year, I mean, you've observed it from a different position, but involved in figuring out what to do when a big bank, a huge bank, gets into trouble. Now, you're both a member of the New York Bar, you've lectured in business law at the University of Zurich. You're originally, in terms of your education, from the Geneva Institute, Graduate Institute, which is well known also among economists, and you have degrees in law and international relations from that institute. So, and a PhD of law from University of Bern. So without further ado, thank you for joining us. We're looking forward to what you have to tell us.
Well, thank you very much for this kind introduction, Volker, Wieland, and it's really a great honor to be invited to this conference marking a decade of the banking union. So sincere thanks to the president of the Supervisory Board, Mr. Gstädtner, and Volker, and of course my friend Professor Christos Gortsos for inviting me. So looking at the agenda, our conference today is not just a reflection on the past, but also a look into the future. So let me take this approach and first look back and then look ahead. Well, the establishment of the banking union 10 years ago was a response to the global financial crisis. And as we have heard, two of the banking union's three pillars are now in place. Both of them, the single supervisory mechanism and the single resolution mechanism, have been instrumental in fostering a more robust and integrated bank regulatory framework. I mean, Thomas earlier elaborated it, and I think Christos will give you a bit more detail on the history of what happened 10 years ago. But no stool can be stable if it only has two legs. The third must be as strong and as firm as the other two. So representing the community of deposit insurers, my interest is naturally in the third pillar or the third leg, which remains pending and would be the single deposit insurance scheme. But 10 years ago, at least the directive on deposit and guarantee schemes, the DGSD, was adopted to make sure there was one deposit insurer at least in each member state that met the requirements and actually aligned with our IADI standards, including fast reimbursements of insured deposits in the event of failure, and established this level of 100,000 euros. And alongside the DGSD, the Bank Recovery and Resolution Directive was agreed and by 2014 had been implemented in EU member states. The BID is also fully aligned with international resolution standards as set out in the Financial Stability Board's key attributes of effective resolution regimes, which were adopted in 2011, so before then. But 10 years ago, the FSB released a series of additional resolution policies and proposals to implement the key attributes, and this included proposals on total loss absorbing capacity of GSIBs in resolution. So these proposals were then proposed 10 years ago, but then finalized in 2015. Then also the principles on cross-border recognition of resolution actions and of temporary restrictions on stays and early termination rights, and guidance on cooperation and information sharing with host authorities of jurisdictions not represented on crisis management groups. And, well, when push comes to shove, we need to know whether a bank is actually resolvable under those resolution regimes and policies that have been put in place. And therefore, 10 years ago, in 2014, the FSB launched the so-called Resolvability Assessment Process, or RAP. And the RAP has so far been an annual process. It involves an evaluation on an institution-specific basis of the authority's preparedness for the resolution of global systemically important banks. It's essentially a self-assessment of resolution authorities, of their capabilities in light of the bank's structure and resolution strategy. And those initiatives taken together, including resolution regimes, resolvability assessments, advanced planning of the authorities, really represented a significant step forward in addressing lessons from the global financial crisis. Well, now turning to deposit insurance. Also a decade ago, the International Association of Deposit Insurers, we say IADI is sort of the acronym, for the first time revised its core principles of effective deposit insurance systems. And these had been adopted in 2009, so first revised in 2014. And this first revision stressed the need for a greater integration of deposit insurance with broader financial safety net, closer coordination amongst deposit insurers, central banks, resolution authorities, and financial regulator. The revision also emphasized the role of deposit insurers in the resolution process of failing banks, the need for adequate capabilities and resources, and for closer cross-border collaboration amongst deposit insurers in home and host jurisdictions. And finally, the 2014 revision also introduced the so-called 7-day standard for reimbursements. So where are we now? Well, for a decade now, we have had in place, or we were working to put in place, regimes that would enable authorities to handle bank failures without exposing taxpayers to the risk of loss. And since the launch of the resolvability assessment 10 years ago, the RAP, the FSB had been reporting consistent progress. Also at national level, several jurisdictions, including the US, UK, and Switzerland, published the state of play for the resolvability of their largest institutions, and they too observed significant progress over the past decade. However, did this steady progress over the past decade lull policymakers into complacency? Maintaining momentum in resolution planning and dedicating the significant resources needed to bolster crisis readiness for darker days poses considerable challenges. So this year, those regimes have been put to a real test, and well, how did our regimes fare? Well, to the surprise of many, the approach chosen by the Swiss authorities to resolve Credit Suisse in March 2023 departed from the preordained resolution strategy prepared by the authorities. There was no write-down of the total loss-absorbing capacity, the TLAC, or the bail-in bonds. By contrast, the Swiss authorities ordered the write-down of AT1. We did not see any recognition of resolution actions or stays on early termination rights, but we found that there remained some execution risk with respect to the bail-in of instruments traded in jurisdictions other than the home country. Swiss authorities cooperated closely with the UK and US authorities. They together formed part of the core crisis management group, but we learned that closer communication with authorities in jurisdiction not represented in the core crisis management group, so as recommended by FSB guidance, could have been beneficial, particularly in time zones where financial markets open earlier. And despite the improvements in resolvability reported by jurisdictional authorities and in the FSB annual resolution reports, the recent episodes exposed gaps in the implementation of international resolution standards, and notably it highlighted the critical importance of access to liquidity in resolution and of a public liquidity backstop, which in Switzerland was not available and therefore required emergency legislation. And the turmoil in the US banking sector demonstrated that even non-systemic banks have contagion potential. If a risk is common or perceived to be common among similar banks, the collective impact can pose systemic risk. It is thus important to consider the design of deposit insurance system and to make it possible to apply resolution tools to any bank, regardless of size or business model, to enable its orderly exit from the market. And as such, the UK approach to the SVB failure involved a transfer to HSBC rather than liquidation and insolvency. So all SFB customers maintained continuous access to their accounts, which helped maintain public confidence. So the UK government is now proposing the introduction of a new mechanism to apply it alongside existing resolution powers, which would enable the Bank of England to request funds from the deposit insurer, the Financial Services Compensation Scheme, so ultimately provided by the industry, to cover certain costs associated with non-payout solutions. And the European Commission's proposal likewise seeks to provide authorities with more optionality in the use of resolution tools and the use of deposit insurance funds to support non-payout solutions that protect depositors while maintaining operational continuity. So these recent proposals raise important questions about the interface between resolution and deposit insurance. In Europe, in contrast to countries outside of Europe, there had been a clear separation between resolution and the reliance for resolution funding on TLAC, MREL resolution funds on the one hand, and bank liquidations supported by deposit insurance payouts on the other. And to date, there had probably been many more bank liquidations of very small banks with payouts to depositors and resolutions. In Europe, the majority of deposit insurers do not have extensive resolution mandates, which may be largely actually due to the separation as it is reflected in the BRRD. Outside of Europe, the situation is different. Deposit insurers are much more often involved in resolution. According to our statistics at IADI, for instance, 40% of deposit insurers outside of Europe are either loss minimizers or risk minimizers, whereas in Europe, these are about, well, 28%. Thus, it's important to place the role of European deposit insurers into perspective. For smaller banks, the deposit insurance matters provided we agree that the aim of coverage limit is to limit run risk by offering deposit insurance to large majority of depositors. So both at EU level and at the global level, the level of covered depositors is very high. On a global scale, this ratio is 98% of depositors and has consistently been high since 2015. In the EU, it ranges from about 75% to 99.8%, with the median at 97%. And this is based on a report from the European Banking Authority last year, but it also aligns with our data at IADI. Coverage in European jurisdiction is just about over $100,000 US, so 100,000 euros, which vastly exceeds the global average, which is $67,000, but it's significantly less compared to the $250,000 US protected in the US. The share of aggregate deposits that are fully covered by deposit insurance in Europe is 57%, as compared to 47% globally. And this obviously suggests that few depositors that are not fully covered hold over half of the uncovered deposits. And this measure in Europe is similar to the one in the US, and we have seen over the last decade a decline of this coverage ratio both in Europe and in the US. And it's important to stress here that these ratios are based on aggregate statistics of deposits in the respective banking sectors, and that ratios of uninsured deposits at individual banks may massively differ, as we've seen in the case of Signature and Silicon Valley Bank. For instance, SVB had 93.9% of its total domestic deposits uninsured. Well, looking ahead, the 2023 banking turmoil has led to widespread reflection at the international level on how to reduce the risks of banks failing and to contain the impact of bank failures on financial stability. And the aim for this year is to apply the lessons from last year's turmoil. The FSB will be working on further enhancing bank resolvability with a focus on public backstop funding, resolution strategies and cross-border recognition of bail-in processes, as well as speeding up responses to bank runs. And in close cooperation with the FSB, IADI will explore the interactions between resolution frameworks and deposit insurance. The centerpiece of our work this year is the review of the IADI core principles and its accompanying handbook. And this review will consider the lessons set out in last year's report, where quite a few of those in the audience thankfully contributed to. And the report looked at the potential implications of the turmoil on deposit insurance system policies. So the main areas of focus will be deposit insurance design, the interplay with resolution and financial safety net coordination, the adaptation of deposit insurance system policies to the evolving technological and regulatory landscape. And we'll also explore procedures for more rapid reimbursements, leveraging technology to meet depositor expectations. What we have learned is that speed matters. The IADI core principles expect reimbursement within 7 days. 7 days sort of feels very long in a 24/7 instant payment world, yet it's not entirely clear how relevant speed is to depositors' run behavior and whether quasi-immediate access to at least a proportion of the insured deposits would help to stem that risk. So these and other matters will be explored as part of the planned review of the core principles. We will follow with interest the discussion in the EU and UK and elsewhere where reforms are pending. And to close, let me just express some wishes for the next decade. I mean, we have made very significant progress with the creation of the banking union, starting more a decade ago. So I think that's quite impressive. But clearly there is still unfinished business. Last year we saw what potential bank runs might look like in a digital world. So this episode clearly highlighted the need for authorities to possess the capacity for flexible and predictable responses, but within the established framework, so avoiding the need for extraordinary interventions and makeshift solutions. And such predictability is crucial in building depositor trust and mitigating the risk of runs. So returning to the analogy of the three-legged stool, a strong third leg, being deposit insurance that is complementary to and at the same time an integral part of the crisis management framework, is critical to foster depositor confidence and reduce the risk of runs while maintaining financial stability. So with that, let me conclude. I very much thank you for actually listening, and I look forward to a very animated discussion in these 2 days. Questions? Yeah, I'm happy to take any questions.
I'll moderate it.
Okay.
Spontaneously. And I think there is some interesting topics. So any questions you may ask? Yes, Christos? Maybe we need to have a mic so it's also the people, the people who are...
Otherwise we can repeat.
Yeah, so the people who are online, welcome to them also, but that they can understand you.
I will then thank you officially, but now it's a question, Eva. There are some discussions about increasing potentially the minimum level of coverage from the N equivalent of 100,000 euros, yeah, to a higher level. Are there any discussions within the IADI with regard to this specific aspect? We have seen the report that you mentioned, published in December. There is a lot on the agenda, yeah, a lot of ideas on how to reform the 2014 rules. But on this specific issue, I have seen even in the EU some discussions. I have recently seen a paper by the EBA discussing that not create a significant problem if the amount were derised. So I would like to have your opinion.
Yeah, the IADI core principle, they set out the principle that deposit insurers should review in regular intervals. I think it is 5 years. The adequacy of coverage levels, taking into account inflation and the general environment. So that should be done, whether, I mean, as a global organization with 95 members, it's very difficult to be prescriptive with respect to the level of deposit insurance coverage. And as I said before, globally, the coverage per depositor is very high. It is 90, 95, 96%. The question that is being discussed is, what about how to stem run risks? Should there be coverage of, full coverage of transaction accounts like in Japan? I mean, these are discussions that are taking place. We have also seen in the UK proposal is to, I mean, there are discussions underway to increase coverage. Hong Kong recently published a consultation also proposing an increase in coverage. I can't foresee the discussions taking place at IADI, but would not expect that there will be specific proposals as part of the core principles that are so prescriptive in terms of the types of deposits, whether or not to insure, for instance, business payments accounts, etc.
Other questions? Yeah, Professor Goethe.
So thank you very much for your introduction. When you were speaking about the SVB case, you said an important thing in my view is the ability to continue providing access to the accounts, also for the professional clients, for large corporations, and so forth and so forth. Would it also make sense to start thinking of detaching basically the discussion about access to payment infrastructure on the one hand to coverage of savings deposits basically deposited with banks on the other hand, so the coverage discussion. So the question is, are these two different things, and should we start thinking of instant payments and everything that you just said, the expectation of customers of banks, whatever the view is on the money that they have deposited in savings accounts, have full access, timely and immediate access basically to the payment infrastructure? And aren't these two different things? That's my question to you.
Yeah, I think I would agree that there is a separation here, and there is on the one hand side the continuity of critical economic functions, which becomes relevant the more the larger and the more relative systemic an institution is, and so we have seen that even in the UK SVB case, the Bank of England decided it's less disruptive to essentially maintain continuity, which also means that essentially all depositors are protected if you transfer the operations to another bank, as opposed to carrying out closing the bank and liquidating it. With respect to smaller banks, it seems there are more technological solutions that would enable enable instant access or continued access. I know amongst our membership there are different ways to do it, to give depositors credit card type instrument to access, have this continued access. So there may be technological solutions to that, but I think the recognition now has been that, well, systemicness is not just a question of size. I mean, you could have, depending on the environment, even smaller banks, similar situated, where in a nervous market environment that could then lead to systemic disruptions, and where solutions that actually maintain operations are preferable to those that involve closing the institutions.
Tobias Tröger.
Sorry, uninsured deposits are the big thing. So I was wondering if there are any thoughts about how to prevent depositors of uninsured deposits from running, because there's an interesting example of a similar situation at mutual money market funds in the United States, where supervisors now have introduced redemption charges. And what that does is, of course, it changes the incentive scheme to a certain degree because it makes redemption costly. So it's not that you just compare the likelihood of the bank's failure and the expected value of rolling over your deposits. It's also that you have to compare it with the charges that are levied if you redeem your deposits. And my question is that something that really helps? And if so, are there discussions to introduce that as well with regard to bank deposits?
Well, there are quite lively discussions ongoing in academia, these various ways to address the system of bank runs of uninsured. First, for deposit insurance. I mean, deposit insurance is not the panacea, it's not the solution for everything. And having limited deposit insurance is only credible to extent that it is also well funded, and it provides for a degree of market discipline by being limited. Then what do we do about uninsured deposits? Of course, a deposit is by its nature different from a money market fund. So, I mean, if the question is, why do we then call it a deposit? I mean, you can make it just limit the amount of deposit holdings and make it more attractive to move funds into money market funds. The other proposal that I actually sort of find quite interesting relate to the prepositioning, where banks are required to preposition collateral in the amount or to some extent of their uninsured liabilities, so as to enable banks to access liquidity at the lender of last resort more easily than was done before. And of course, in the extreme of this proposal, the pawnbroker of all seasons, Mervyn King, Paul Tucker proposals may be extreme and radically change the nature of our banking system, and that may not be practical, but maybe some elements from this proposal might help address the issue of and I think finally, does it address the bank run issue? And I don't think it enables authorities to deal with the bank run, but I mean, if the bank run itself, it's may not be prevented, because bank runs happen because of radical loss of confidence and in such way unpredictable. But the question is, how do we deal with them? They happen.
Maybe I can ask a follow-up question. You mentioned, I don't know if that comes across also with the mic, you mentioned SVB and the collapse there, the high share of uninsured depositors. That also goes to what Tobias asked about. But if one looks at Silicon Valley Bank, and this applies also to a lot of the local smaller banks in the US which are in trouble, I mean, they did have reserves. They did have investments in government debt, very secure US government debt. So they could have sold that. The only problem, and basically thereby shored up their situation, but the only problem was that this was held to maturity and so booked at the nominal value. So given interest rates had risen, they would have had to post losses if they had sold these. This is also a problem. This is the big elephant in the room with the smaller banks. As a response, so in a sense, one question is, should one deal differently with these options to hold to maturity and not force more or large amount of reserves which are booked to market? In the event, I think it was extreme what the US did. It's just like a throwback, in a sense, to the financial crisis. I mean, the Federal Reserve basically said, okay, we're going to provide you liquidity so that at the nominal value for all that, and so essentially help guarantee all these banks who have this exposure. That's maybe not what one intended with the Basel III reforms to achieve. So how could that be managed better, or what aspects of regulation do we need so that there aren't such large interest rate exposures?
Yeah, no, I absolutely agree that there is a supervisory dimension, and I think maybe it's the next panel even that will be discussing some aspects of that, and which may even come first before we just discuss deposit insurance, crisis management. And I mean, at the end of the day, it's also SVB. These were outliers, even amongst US banks, probably. Nevertheless, I mean, it's interesting. I mean, we have seen a real digital bank run, which gave us a feel how quickly things happen. And I think that maybe even in the future, in situation that may be quite different, we may see this speed to deal with. But I'd agree that I mean, we have to look at supervisory approaches and bank risk management in the first instance.
So thank you very much. I think I don't see any immediate questions, or maybe we stop here. Thank you very much for coming to Frankfurt and sharing your thoughts with us.
Good morning. On behalf of all my colleagues in the academic board of the EBI, I would like to welcome you in this 2 days conference, those of you who are here and those who are participating remotely. I'm Christos Gortsos, and I'm the chair of this academic board. We have organized the conference after 4 years in this place, and many thanks to Goethe University, Tobias and Volker, for hosting this in that place. And the title contains 2 legs. I would say the first one is the catchy part, the banking union at 10. And the second contains the substance. And to a certain extent, it might be a kind of inconsistent, the banking union at 10, and then developments in capital markets law. What's going on here? First of all, it's a matter of fact that, yes, 10 years ago, as a matter of fact, on the 4th of November 2014, the SSM became operational, meaning that the first leg, at least, of the banking union was operational at that time. But the SSM regulation had been adopted 1 year earlier. Yep. In a very short period of time, by the way, after the European Commission had submitted its proposal. But then the second leg is based on regulation, the SSM regulation, which was adopted in 2014, but started operating in 2015 and fully operating in 2016. But yet again, it is concrete to say that the SSM is at 10, at least when it comes to its start. And by the way, the complete banking union is not yet in place. Yeah, Thomas, you mentioned that before. We still don't have the EDIs. I can say additional pillars which are not in place, including a centralization of lending of last resort, or any other elements that you might wish to include into a concept of the banking union, which, by the way, is not a legal term. The term banking union is rather a political term, but you don't find a definition of what is in legal terms. Yeah. Volker, you are among too many lawyers today, so I'm sorry for that. But it's great that you are here and you will your tone later on. Now, at the same time in 2014, nevertheless, a lot of other developments took place, both in banking regulation and in capital markets regulation. I will start with capital markets regulation because it's the easier part in that respect, but we had a MiFID II, yeah, which is one of the most significant building blocks of European capital markets law. At the same time, in 2014, 2 months after the adoption of the MiFID, you had the first mentioning in official terms of the term Capital Markets Union. And that was by the then candidate President Juncker, who mentioned that in one of his papers delivered in July, August, I don't remember, 2014, that now that the banking union is starting to operate, let's strive also for a capital markets union. By the way, a kind of misnomer, because if you compare the banking union, the idea was the centralization of banking supervision, banking regulation, resolution, and potentially deposit guarantee, while in the case of capital markets union, that was not the immediate idea. It was the development of a higher degree of harmonization of the rules. Coming back to banking regulation, nevertheless, in 2014, we had the adoption of the BRRD, which was the first legislative act on the harmonization of resolution actions and resolution planning at EU level. Some member states, including my country, under conditions, Greece, under condition of urgency, had already adopted rules on the resolution of credit institutions, but this was based on the proposal or on some of the international standards that had already been developed. But it's in 2014 that we have the BRRD, which was then fully implemented in 2015-16 with regard to the bail-in. And then in the same year, we had the second deposit guarantee schemes directive, the one which is still prevailing, which repealed the one from the 90s. Yeah? And at the same time, in 2014, on January 1st, you had the entry into application of the Capital Requirements Regulation and the Capital Requirements Directive. It was expected that the member states would have implemented all the rules by January 1st, which was the case. So in that respect, 2014 is very significant, yeah, because it marks the year in which some measures which had already been taken in 2013, were put in place. A lot of legislative acts were adopted in 2014. In November 2014, you had the start of the operation of the SSM. And this meant, as a matter of fact, the point of time at which the two crises which preceded 2014, meaning the global financial crisis, 2007-2009, and the euro area fiscal sovereign debt crisis, which started, unfortunately, from my country, but spread over to several countries in the periphery, at least, of Europe, because some countries were affected, even though they were not in the periphery, and they did not create the burden that the countries in the periphery created, but this is beyond the discussion today. So it was a time when all the measures that had been perceived and adopted then reached gradually the point of maturity. And this is 2014-2015. And I'm grateful that Eva Hüpkes has accepted our invitation because I think, and we at the academic board thought, that it would be an excellent bridge between the developments at international level and the developments at European level. Because as a matter of fact, we will hear that in the first panel, the CRR and the CRD4 are kind of children of the Basel III, as we call it, even though you already had legislation on that. The BRRD is a child of the key attributes of the FSB, correct? And on this, we didn't have any legislation before, so that was a novum. In the field of deposit guarantee, we had already a directive. Eva mentioned that in 2014, you had the core principles of deposit guarantee. This did not necessarily influence the European framework because most of the elements in the 2000s, most of the principles in the 2000 rules were already embedded in European legislation, but still this interaction between international and European law was of significance. When it comes to MiFID, it's more obscure because I do not believe that there is a single IOSCO document which has influenced the shaping of the MiFID II, even though there are some elements which can be the necessary link between international and European development. Now, 2014 is a long time ago. It's not too long, It's not 2004 when Greece organized the Olympic Games. I think this is in my previous life, and at the same time, we won also the football championship. And at the same year, we won the Eurovision. This is unique in the history of Europe, but this is far away. But now we are in 2024. And we thought that it's a very good idea not to pay tribute to 2014, but to see how these rules have developed. And as you can see from our program, we have 6 legs. Today, we have the 3 first panels, which are on banking regulation and how this has developed, the impact of Basel III. Then we have panel number 2, which is on banking resolution and, in more general, crisis management and deposit insurance framework. So we are covering the second leg of banking regulation. And then, in leg number 3, we'll have a discussion on capital markets law and how this has developed over these years, from 2014 to 2024, when the MiFID II has already been modified. I don't remember how many, 26 times. And eventually we'll have a MiFID III very soon. The Capital Markets Union project has been put in place, yeah? And this gives the necessary link to a fourth development, which in 2014 was not in the making, but still the Capital Markets Union Action Plan of 2015 was the trigger for that, and I refer to sustainable finance law. Because apart from the various measures that have been taken then, which go beyond the link to the Capital Markets Union legislation, you know very well, and I simply remind you or recall that one of the major pillars of the Capital Markets Union Action Plan in 2015 was the creation of a system of rules on sustainable finance, which led to the adoption later on in 2019-20 of the taxonomy regulation and the sustainable finance disclosures regulation. And we have a panel which will discuss this tomorrow, the development in sustainable finance law in our days. The roots are not in 2014, a little bit later. In 2014, the only act of relevance was the non-financial disclosures directive, which amended at that time the accounting directive. But you would not say that this was the beginning of sustainable finance law in Europe, even though, of course, that was important. And then I have tried to check it very thoroughly. I didn't find any single act in 2014 which can lead to a comparison to what we today call digital finance law. Yeah, it all starts a little bit later. 2015, 2016, we have again action plans, and we have the FinTech action plan, which is of 2016, 2017, yeah? But in the meantime, you cannot organize a conference, an all-encompassing conference on European financial regulation, and we're not speaking here about European insurance regulation, without putting an emphasis on these two pillars, sustainable finance and digital finance. And this makes the 5 pillars of that. In the meantime, of course, the European Union has legislated, but the courts are also there, and they need to interpret the legislation and the actions taken by the institutions which are involved. And so we thought that the closing panel is not, it's a round table, yeah, led by our dear friend and colleague, Chiara Zilioli, and with the participation of members of the academic board and dear friends, we'll discuss this evolution of jurisprudence during the last 10 years, with an emphasis on the banking union, but not only the jurisprudence, also the decisions taken by the 3 quasi-judicial fora panels which exist, speaking about the ABOR in the framework of the SSM, speaking about the Board of Appeal for the ESAs, and about the appeal panel for the Single Resolution Board. So I hope that if you manage to follow the entire conference for 2 days, which I very much doubt that we can all do, yeah, you will have more questions than when you joined this room or you joined your link today, yeah? I'm not sure whether we will be able to shed light to all the outstanding issues, but I think that the discussions will give us the opportunity to further reflect, yeah, on a moving target, because the second leg here, European banking and capital markets law, is a moving target. Two more points before I give the floor to the part for the first panel. If there is something that I have learned, and we all have learned, is that if you ever find a textbook on European banking law of 2014, please don't teach it to your students. It is totally outdated. Yeah, I tell you from my own experience, I have one of 2023, which is still valid, but I think in 2 years it will not. But a textbook on European banking or on European capital markets law of 2014 should be taught in a course of late Roman law. Yeah, it's far away from what applies today. This shows the dynamic of the field. Thank you very much for being here. Many thanks to the Goethe University in particular, Volker and Tobias for inviting us. Thank you, Eva, for having been here and making this necessary link between international European law and for staying with us. And many thanks to my colleagues in the academic board. This was an idea that we conceived last year. We worked together as a group and we managed to have that. The 5 panels will be chaired by the coordinators who will take all the merit for having selected the persons who are participating. All the blame goes to me and all the merit goes to them for the excellent job they have done to organize these panels. Today we have 3 panels. The first one will be chaired by Bart Jossen, our dear friend and colleague, and my predecessor as chair of the academic board. As a matter of fact, the last meeting here in 2020 was under your chairmanship, and today you are here again as a moderator of the first panel and, of course, a great friend. The second one is, I don't see Georg. Is Georg here? He will be coming. Otherwise, Bart, you will also moderate the second one. Or I will do, I don't know, you will tell me. The second one will be moderated by one of the vice chairpersons of the academic board, Georg Ringe, our dear colleague. And the third one by my dear friend and our dear friend and colleague, Rolf Sette of Capital Markets Law. On the moderators for tomorrow, I will speak tomorrow. Thank you very much, and I wish you a very nice day, or 2 days if you manage to stay here. Thank you.